What I'm about to show you is something that took me years to master, but it has allowed me to predict markets to the absolute T. Now, this is not no beginner-friendly stuff. So if you want some special effects and end up the video not learning anything, you can go towards any of these other gurus. And there's a lot to go over, so I'm gonna divide this video in 2 parts, so don't hesitate in subscribing so you don't miss part 2. So we're gonna do the whole month of January for this year, and then the whole month of February for the next one. As you can see, this is recent price action. This is not no perfect month, week from 2022 or something like that. This is all recent. So obviously, ping pong trading is only possible with liquidity, right? And it's not the type of liquidity that SMC and ICT traders do. But those guys know about liquidity is just a surface level. So you know that price will consistently go from one liquidity to another. Boom, we sweep the highs to sweep something lower, to sweep the highs again, to sweep something lower, to sweep something higher, to then sweep something lower. And all these liquidities can also be translated into smart money traps. So if we zoom in on this hourly liquidity sweep, this first trade is very easy. It's very easy. You just have New York running towards the liquidity because it's a magnet, and as soon as it gathers that liquidity, it still wants to go up, but it's London close now. And London close tends to be a retracement of the day. So if New York was all bullish, London close will tend to be a bearish move. And in here, you got your 3R, and you just position yourself in a change of character that's visible on M5, M15 candles, potentially even M1 structure. Moving on to the second one, and I know this will be fast, but this is gonna be a lot of repetitive stuff, and it's also convenient for the TikTok brains, so we're consistently changing, all right? Second one, also very easy. You go into your day, you wait for the market to open on futures, and as soon as it does, you look for some liquidity sweep. So imagine you're starting your day right here, waiting for the market to open. You have Asia highs and you have, well, London lows, let's say. You wait for one of them to get taken. The highs were taken, so you instantly look for shorts. And boom. Nice trending day to the downside to go search for a liquidity that was the previous daily low. And it's not just the fact that it's the previous daily low, but the fact that it looks too good to be true for SMC traders. This is a smart money trap because price can't just go up like this without taking any liquidity. And because this was a trap, this right here on the shorts will be a trap. But that's for later. And now that you got the shorts taken, well, on the next day, you look for buys because you know this level will be a trap soon and price is overall bullish. So then again, once price opens, you see that it sweeps this level. London had already swept Asia. New York had already swept London. Right now, all you need to have is the open sweeping something. That's the best case scenario. If it doesn't sweep something, well, it's going to be too risky. You're going to be positioning yourself and price will most likely go search for your stop. So you always wait for the market to be open. In the first 5 minutes or maximum 30 minutes, you'll see a sweep. And then you try the reversal of that sweep. And if you zoom in on this, you can get a nice entry on M1. But you can see just by the candles as this green one surpasses this black one. And you don't even need to go for these big risk to reward generational wealth type of trades. Just go for the 3, you'll be way better off. So you don't be like ICT traders with a 2% win rate. All right. But going on to the next one, and this is a perfect point on the risk to reward. Because in here, we're looking for liquidity to be swept to the downside in order to go search for the high time frame one to the upside, which holds much more liquidity. And it's very predictable that we're going there. But by trading this, we're trading inside the range. That's this one right here, right? You have 2 major liquidities, and anything you trade inside of this block will ultimately be kind of risky since price can do whatever in here, as you can see it's doing. All right, it goes for that liquidity that we know will get taken, but at the same time, you might get some bullshit inside of it. That's why anything here, it's the internal setups. And after the sweeps of liquidity, these are the external and most safest setups that you can take. So all of this is just playing around to trap people, to trap them on the longs here, and then to trap them on the shorts here because they'll see, well, the previous daily high got swept, So let's short it here, not knowing that there's a major liquidity just above, right? The trade will kind of look like this. It's a shame that it didn't went for the TP of the structure, but if we would have went for the 3R, well, we would almost get it. And then as you can see, London close hits at the end of New York. New York was bullish. It goes search for the London price section. If you haven't, like, I'm saying a lot of stuff, but all you have to do is go look at my channel and you find all these concepts. I just can't be here and explain you every single concept nice and detailed, because otherwise this would be a 5-hour video. I hope you guys understand that. Then on the next day, you have the sweep of the previous daily low. London sweeps it. You don't trade London, so you don't trust it. You can see how London even does a nice little rejection on it, but whatever. You wait for the New York Open, and New York Open sweeps London, immediately bounces from it. You immediately look for buys. It's way easier than Forex, because in Forex I will tell you to not only look for the sweep of liquidity, but also a smart money trap following that. And in this case, you don't need to wait for a smart money trap. Price in futures just normally sweeps the liquidity and immediately reverses. That's why you find ICT traders, some, of course, not all, not every, being profitable on futures. Because it's that easy. You just have to know the principle of liquidity. But then on Forex, you need to know the principle of liquidity, but also the smart money traps just following that. And they kind of struggle with the smart money traps. There was also smart money traps here. On more like the vision side, as you can see, if they trust the previous daily high, they will get trapped here. And if they trust this beautiful rejection later, then they will get trapped. Thinking that because we went for the highs, this is a breaker structure where it's only a liquidity sweep, meaning that we'll take this out. Yeah, big stop loss here. So only going for 2R for the liquidity, because if you were to stretch this to 3, it's not that we're reliable, because you know as soon as we sweep this liquidity, there will be a reaction. And that reaction could be small and then go towards the OTP, or it could be big and then immediately tag you out. If you're a prop firm trader, you should be using Prop Firm Match. I've been using their platform for years, and every single time I want to buy a new challenge, this is the first place I check. Instead of going to each firm's website and opening 15 tabs and compare every single one of them, you can just check Prop Firm Match and compare every major firm side by side, everything in one place. You can filter by rules, drawdown types, profit targets, if the firm has MetaTrader, if the firm has CTrader, if it's a Forex firm, if it's a futures firm. And the best part is that Prop Firm Match tracks the highest discount going across all the prop firms, so you're always seeing the best pricing for each challenge. For anyone that's looking to diversify the prop firm allocation and look for the best opportunities in prop firm space, I'll leave a link to Prop Firm Match in the description. Sweep of Asia, you don't care about it. Then you have a sweep of London. This you might have, if you're fast, of course, might do a ping pong here. Go for the longs to then go for the shorts. But then again, you'd have to be super fast, and you probably wouldn't get it. Maybe on the seconds, right, at open, and you can predict the market to go up, as liquidity is just a magnet for price. So the price opens here and immediately goes for that major liquidity, which is also previous daily high. Not only previous daily high, but the major liquidity on higher time frames, which we were consistently seeing here, and it's building equal highs towards it. Okay, so then same thing. We go for the highs to go look for the lows, right? Making this beautiful rejection a smart money trap. And then because this was a trap, guess what? This for the future will be a trap. So as price sweeps these lows, maybe you would have gotten trapped here. Maybe you saw this sweep of Asia and you could have entered on the shorts here just to take advantage of this liquidity. But then again, too fast, too many playing around. Maybe you would have gotten stop loss, break even, or it would be too much of a small risk reward to even risk it. And then on the longs, you could have possibly be taken out here, as we kind of doing the smart money traps, which reminds me of Forex here, because it's not only about having the sweep of liquidity and then immediately reversing. We do play around a bit here, and I'm gonna give you a little tip. When we sweep the liquidity, but we're kind of playing around, that means there will not only be a smart money trap, but you most likely have to wait for London close. You would have thought that this move will be the one, and then it does another sweep to it. And that sweep, it's immediately at the end of New York session at around, I believe 11 a.m. in New York. And because London was bearish, New York was bearish, London closed bullish, and you would have gotten your TP. And because, well, this was a trap, this would have been a trap the same way as all of this. And the next day, this becomes a previous daily high, which gives you even more confidence, right? Because you're positioning yourself because of liquidity sweeps, and your targets are other liquidities. Your reason behind the trades are other liquidities, since we always go from one liquidity to another. That's what will allow you to go to do these ping pong trades that I'm showing you. So then later, and you can see that this is a risky one right here, you try to short on this level, knowing that there's a super small amount of space between the high and the major liquidity here, right? So it's super risky trying to short super close to a liquidity just above. But if you do manage to get some space in between this, you see that we open, sweep the previous daily high. Pretty fucking simple. We do a change of character, and that's it. Market open, sweep of liquidity, change of character. It's that simple. Well, perhaps you're not going to exit this video, apply it, and immediately become profitable. You can, but you know that there's a lot of more stuff like psychology, other conflicts that I haven't spoken about, risk management, money management. But if you want to excel on any of those, then check the first link in the description. As we go down here, there's not much to do apart from having this inducement sweep, and then it's also London close, so it gives that nice little retracement as New York was bullish. And then of course you have this smart money trap, because they're seeing, oh, okay, London came to test out this order block, now we drew this order block, now price is going to do this and continue to go higher, and then this, and we don't see any sweeps of liquidity. We just go higher. And if this were to be the case, then we all be millionaires. And this is probably the reason why you get so many stop losses. It's because your strategy is only composed of one single concept, and it's order blocks with no fucking market reading. So yeah, London bullish, New York bullish, London close, bearish. It's crazy how simple it is and how powerful it actually is. The longs were the traps, then later the shorts will become a trap. This because the smart money traders are thinking, oh, okay, we weren't actually bullish, we're actually bearish. So as soon as we come to this structure, that swipe liquidity, let me short from there. And then they'll get trapped on the shorts as well. And you can see it's not random by this impulsiveness here. And this impulsiveness also comes from the strength of the sweep of liquidity. The higher in the time frame the liquidity is, the more powerful it will be. And then again, as I've said previously, this impulse makes a pretty fucking easy smart money trap. If it's too good to be true, then it probably is. Like when I see these guys having these order blocks drawn on some huge moves, like you really think that price is gonna come back and then do immediately this again. It will probably take all the liquidity out of the market, and then go to the opposite direction. And then again in the future, it will probably take it again. Well, in this case, you were lucky. Right? We trap SMC traders, but one time out of 10, we gotta let them have the profits, because otherwise they would just stop trading SCT. This one here, it's actually previous to the market open. It's just decent because you have double sweep before the market open. So the only reason why I also say there's not smart money traps in futures is because the market open would tend to sweep the liquidity and tend to deliver the smart money trap. So instead of having the sweep of liquidity and then a double sweep, you don't count it as a double sweep since the market was already open. What I mean by this is you probably have market in New York already doing a sweep, but then because market isn't open, you wait for the market open, and market open does a second sweep into it. But you won't count it as a second sweep since you won't always wait for the market to be open regardless. And so then you have this double sweep, meaning a smart money trap into the liquidity sweep. And here we did exactly that previous to the market open. That's why as soon as market open, it had already gathered enough liquidity and just moved higher like this. You also have another confluence for price to go into the upside since we have this gap. You already know it's magnitude to the price. It's London close a bit towards the end. So I wouldn't really risk it. But then if you wanted to short it here, you could have maybe gotten some smaller profits or a break even or even a stop loss, since the next day just continues to the upside, going for that major red liquidity that we still got up there. In here, we have this beautiful reaction from New York, right? But it is a bit unclear since we already swept this and it still continued to go higher because the market still wasn't open. But as soon as we opened, we did this. But I didn't like this since we had this previous high right here. And if you notice, right, here it's pretty simple that we didn't sweep it. So of course I'm not going to risk it since this is super close to that liquidity above. But later on, we have London close sweeping New York, and this is perfect, as London was bearish, New York was bullish, so it will be a retracement of New York. But it's making equal highs with that liquidity, so I wouldn't trust it, even though in here you would have gotten a win just from shorting this London close action. And if you check to the right, you have these equal highs, you have the major liquidity to the upside. It takes a bit of time because it plays around. Look, another equal high, and then boom, it eventually sweeps it. Because we have this, the shorts are a bit risky, but you do have a sweep of previous daily high here. There's a bit of distance between these. London close, sweeping it. London down here, New York bullish, so price will most likely tend to go there. You can see that there's this liquidity below, this fake high that didn't take no liquidity and then came to retest nothing. We sweep it in London, but you don't really care about it, since you wait for the market to open, and then as the market opens, it does a second sweep into it, making it a smart trap for anyone that was trying to short it and trusting this London high, being on it too early, being stopped out, and then as soon as you take the shorts afterwards, then you get rewarded. And as soon as you have this sweep of liquidity, then perhaps you could buy from here. So yeah, with that we finish the month of January. There's still a lot to cover on February, right? We'll get to that soon. You can see these amazing ping pongs. But yeah, guys, I hope you guys enjoy. I have a lot of free courses on my channel. 5-hour, 3-hour, 1-hour ones. So you can go watch and learn these concepts on a more educational basis, where I really explain how they work and not just fast forwarding every single trade. But you can see it's just the vision stays the same. It's mostly one single setup, and that's why I go super fast, so you eventually catch on to the concepts that I'm teaching. If you have any questions, don't hesitate in commenting them or reach out to me on IG, as I personally respond to all my DMs. And I'll see you on the next one, boys. Peace out.